under GST law, you have to start with the turnover. And not the turnover as per the audited financial statements. Then you have to do the add less, and then you will come to the turnover under the GST law. Okay, that is just an outline. The turnover as per the financial statements, then the add less, and then you come to the turnover as per the GST law. Okay, GSTR9C has been divided under two parts, Part A and Part B. Right, Part A is regarding the reconciliation, right, which we are going to discuss. Part A is regarding the reconciliation, right, and Part B is regarding the certification. Part B, which is regarding the certification, right? So the auditor, CA, CMA, who has done the GST audit, he is required to give this certificate, right? So what I am going to do, first I am going to take you to the certification. Right, so this is Part A, which is the reconciliation statement. We'll come to that also, but before that we will go to the Part B, which is regarding the certification. Right, Part B, which is regarding the certification. What does it say? We have examined the balance sheet and the profit and loss account, income and expenditure for the period, the cash flow statement. So this auditor's certificate for GST audit, for GST under the GST law, we have examined balance sheet, profit and loss and the cash flow statement. Based on our audit, we report that the registered person has maintained the books of account or has not maintained the books of account. Right, so has maintained the books of account, records and documents as required under the Act, rules and notification. Right, so point number 1, we have examined. Point number 2, whether they have maintained, right, the books of accounts, records and document. Point number 3A, we report the following observation, comments, discrepancies, inconsistencies if any. Right, so we report the following observations, comments, discrepancies, inconsistencies if any. We further report that, something what we do in company law also under section 143(3). And whether we have obtained all the information and explanation, which to the best of our knowledge and belief were necessary for the purpose of the audit. Then whether proper books of account as required by law have been kept by the company. Right, and whether balance sheet and profit and loss account are in agreement with the books of account. I think you might be knowing this. Information, explanation, proper books of account and are in agreement with the books of account. The documents required to be furnished have been annexed therewith. And then the opinion. In our opinion and to the best of our information and according to the explanations given to us, what does it say? The particulars given in the said form number GSTR9C are true and correct. Why? Because it is a certification. Right? The particulars given in the said form GSTR9C. This is the report the auditor has to issue. Right? The particulars given in the said form GSTR9C are true and correct, subject to the following observations, qualifications if any. Right, so this is the Part B, which is regarding the certification. Now I come to the Part A, which is regarding the reconciliation. Right, now I come to the Part A, which is regarding the reconciliation. Okay, right, Part A, what does it start with? First 4, yes, 1, 2, 3, 4 over there. What is 1, 2, 3, 4? Basic details. Point 1, which is regarding the basic details. 1 financial year, so say 17-18. Right, then you write the 15-digit GST registration number of the assessee, right, GSTIN, right, first 2 numbers represent the state, next 10 numbers represent the PAN, then after that the number of registrations of the state, then the nature of the business, and then last one is an alpha or a numeric number which is a check digit. Right, so that is the 15-digit GST registration number. Then 3A and 3B, that is the legal name and the trade name. Right, so legal name like for Indigo Airlines is Interglobe Aviation Limited. And what is their trade name? Indigo. Right, so 3A, 3B, legal name, trade name if any. And are you liable to audit under any act? Right, so say the registered person may be liable to tax audit. He may be liable to company audit. So are they liable to audit under any act? Right, so that is point 1, basic details. What are the basic details? Financial year, registration number, legal name, trade name, and are you liable to audit under any other act? Part 2 is the reconciliation of the turnover declared in the audited financial statements with the turnover declared in the annual return. Right, so everywhere we compare whatever number comes over here with the number which has been filed in the GSTR 9. And whenever there is a difference, you have to give the reason. Right, turnover as per the whatever calculations are done under GSTR 9C, turnover which has already been declared in GSTR 9, and then the difference and the reason. Right, so now turnover as per the audited financial statements. What is my starting point? The annual turnover as per the, right, turnover as per the audited financial statements. Right, to this I will add. Okay, now you know that as per AS9 revenue recognition, say at the year end on 31st of March, some contracts of the company are in process, like generally for software companies, right? Say 30% of the contract has been completed, right? But 70% is yet to be completed and the billing is to be done. The invoice is to be raised when 100% of the contract is completed. But as on 31st of March, there is an unbilled revenue. As on 31st of March, there is an unbilled revenue. Now, on this unbilled revenue, has GST been paid? Unbilled revenue at the end of the financial year, has the GST been paid? No, invoice is only not raised. When will it be paid? In the next year, whenever it is completed, and then the invoice will be raised. But has it been included in the turnover as per the financial statements? Has it been included in the turnover as per the financial statements? Yes. So what does it say? Unbilled revenue at the beginning of the financial year, add. Because that whatever was at the beginning of the financial year, for that the GST, the invoice will be raised in the current year and the GST would be paid. So that you need to add. And unbilled revenue at the end of the financial year, you need to less. Right? So what did I tell you? 5B. Unbilled revenue at the, right, unbilled revenue at the beginning of the financial year, at unbilled revenue. They'll ask you questions in the exam, no? Turnover is given as per financial statements, calculate the turnover as per the GST law. Right, so unbilled revenue at the beginning of the financial year, at, and unbilled revenue at the, right, unbilled revenue at the end of the financial year, less. Then what does it say? Unadjusted advances. Next one. Unadjusted advances at the end of the financial year, add. Why? Because it's an advance. So obviously GST would have already been paid on that in the current year. And unadjusted advances at the beginning of the financial year, less. Unadjusted advances at the beginning of the financial year, less. Okay, what is the expectation? What are they saying over there? Unbilled revenue of beginning of financial year, 5B. Right? Unbilled revenue at the beginning of the financial year, 5B. At the end of the financial year, 5H. They say serial number 5, clause B, clause H. Right. Then unadjusted advances at the end of the financial year, 5C. Unadjusted advances at the end of the financial year, 5C. And at the beginning of the financial year, that is 5I. Right? That is 5I. If not possible, at least we can remember clause 5. See, not clause, serial number 5. And this clause A, B, C, D under that. Right? So did you understand two adjustments? Right. Then when we calculate turnover as per financial statements, when we calculate turnover as per financial statements, do we reduce trade discount? When we calculate turnover as per the financial statements, AFRF, do we reduce trade discount? Yes. Under GST, you have to add back. Right? Under GST, it says it's a part of the turnover. Trade discounts accounted for in the audited financial statements, but which are not permissible under GST Act. Right? So 5F. What is 5F? Trade discounts. What you need to do? Add back. Then any deemed supply. Right? Any deemed supply. Now, if this deemed supply is already included in the turnover, then no need to add it. But if it is not included in the turnover, like, transfer of a capital asset, transfer, not sale of capital asset, obviously it will not be included in turnover. But for GST, even that is turnover. So what does it say? Any deemed supply, even that you need to add back. Right? Any deemed supply, even that is required to be added back. So now pay attention. Then any credit notes issued after the end of the financial year, again add back. So 5 things you need to add back to 5A. What is 5A? Turnover as per the audited financial statements. What are the 5 things which you will add? Unbilled revenue at the beginning of the financial year, unadjusted advances at the end of the financial year, deemed supply, credit notes, and the trade discount. Right? So 5 things you need to add. That is B, C, D, E, F. Right? Then 6 things you need to reduce. Right? 6 things you need to reduce. Right? G, H, I, J, K, right? J, K, L, right? So these things you need to reduce. G, H, I, J, K, L. One, turnover from April to June. Why turnover from April to June you need to reduce? Because the GST law became applicable from 1st of July. That is why turnover from April to June you need to reduce. Unbilled revenue at the end of the financial year, reduce. Unadjusted advances at the beginning of the financial year, reduce. Credit notes accounted for in financial statements but not permissible under GST. Right? So sales return not allowed under GST, you need to reduce. Then adjustment on supply to the SEZ DTA units because they are exempt. Again, that you need to reduce. Turnover for the period under the composition scheme, because composition scheme we will pay the GST separately. So that is why from the turnover as per financial statements, from where am I reducing these 6 numbers? Reducing it from the turnover as per the financial statements. So April to June. Then unbilled revenue at the end of the financial year. Unadjusted advances at the beginning of the financial year. Credit notes not permissible under GST. Supply to the SEZ units and the turnover under the composition scheme. Right? So 6 things you need to reduce. Right, so A is turnover, then B, C, D, E, F is the addition, then after F, G, H, I, J, K, L is the deletion, and then you have 3 points which is plus minus. It could either be plus or it could be minus. Right, there are some valuation rules under the GST law also. Right, so adjustment in turnover due to the valuation rules under section 50. Then adjustment in turnover due to foreign exchange fluctuation. That is the next one. And the last one, adjustment in turnover due to reasons not listed above. That is MNO. So actually not that difficult, how much it looks difficult. And a turnover as per the audited financial statement, then 5 addition, 6 deletions and 3 addition, deletion, any of the 2. That will give you the turnover as after the adjustment above. Then turnover as declared in GSTR9. Turnover as declared in GSTR9, which you are filing, right? And then unreconciled turnover and the reasons for the same. Right. So now let me look into the question for the turnover from April to June. Are you all with me? Right. Now we look into the part which is regarding the turnover from the period April to June. Right. So there is a question which is there in RTP May 19. Right, both old course and new course. Read this. Now how they've asked the question, in terms of serial number 5G of form GSTR9C, the turnover included in the audited financial statements from the period April to June shall be declared and deducted from the annual turnover to arrive at the turnover as per the GST law. Please specify which of the following supplies would form part of the reporting under turnover for April to June. Right, so read. So which will you reduce from the turnover as per the audited financial statements? R raised to 10, RTP May 19 question. And it is only a transitional provision. इसका अगले साल से कोई effect नहीं होगा. And 18-19 you'll pay for the whole year. 17-18 only that you had to pay for 9 months. Okay, read. Right, question number 19, no? Right, question number 19, RTP May 19 old course. Goods were manufactured and cleared from the factory on 1st July on sale or approval basis. The goods were not approved by the recipient and returned back on the, right, returned back on 25th of December. Right, when were they returned back? On 25th of December. Right, so what does it say? Yes, when were the goods sold? Right, when were the goods cleared from the factory? 1st of June on approval basis, and they were not approved. So did the sale take place? No, so no need to reduce it from the turnover. Since the goods were not approved and returned after the stipulated period of 6 months, the value of the said supplies would not be included in the turnover as per the audited financial statement. So there is no question of reducing it for the purpose of GST law. However, as per the proviso, since the goods were returned after 6 months from the appointed date, this GST would be payable for the tax period December 17. So though the transaction originated in the period April to June, the turnover will not be reflected under serial number 5G. So will it come under 5G, April to June? No. However, one may reflect such an adjustment under Part 2, serial number 5, clause O, adjustment in turnover due to reasons not listed above. Right, so it comes in the balancing figure for reasons not listed above. Right, then next one. Goods were manufactured and cleared from a factory located in Bangalore on 30th of April. The goods were cleared to a showroom located in Hyderabad and eventually been sold from therefore on 30th of August. The audit under the GST law will be conducted for the Bangalore GSTI. Right, so they were sold from the Bangalore to, yes, goods were manufactured and cleared from a factory located in Bangalore on 30th April and they were sent to a Hyderabad. Right, so this is a branch transfer. Right, and eventually when did the sale take place? Right, was sold from there on 30th of August and the audit is to be conducted for the Bangalore GSTI. Right, so the said goods are liable to excise duty since the goods have been cleared on 30th of April. Right, the goods would not form a part of turnover as per the financial statement since it is a branch transfer. It would stand reflected as branch transfers under state level VAT laws. Since audit is being conducted for the Bangalore GSTIN and since supply has occurred from Hyderabad, it would not be necessary to make adjustment for April to June. So again for this one, what does it say? No adjustment from April to June. And the last one, right, the telephone bill, mobile bill. Continuous supply of service in the nature of telecommunication service has been provided from 1st to 30th June. Bill is raised on 3rd July. Payment is due on 21st of July. Should the revenue be recognized in the month of June and reduced from turnover, or should it form a part of turnover from July to March since the due date for payment is 21st of July? The entity recognized the revenue in the month of June. Right, so as revenue has been recognized in the month of June, but that time it will be liable to the service tax. Right, June, that time it will be liable to service tax. What does it say? Though invoice has been raised in the GST regime, service tax is payable since service has been provided during the currency of the Finance Act. Okay, the date for payment of service tax as per the machinery provision may be 3rd of July, but the said service would be liable to service tax because the charge under section 66B gets attracted. Further, as per, since if a transaction is liable for service tax, then tax would not be payable under the GST law. Hence, the said amount should be deducted as turnover under this serial number for the period April to June. Right, so only the last one, what does it say? It has to be reduced from the turnover. Right, then there is a point regarding these foreign currency transaction. Right, then there is a point regarding these foreign currency transaction, foreign exchange fluctuation, whether any adjustment is required to be made to the turnover. This is there in RTP May 19 in the discussion, in the amendment part. That was in the question bank, no? The question which I showed right now, April to June. Now this is in the RTP part, amendment part. And a PQR Limited has exported goods to a company located in USA. The value of the goods is $1 lakh. The exchange rate on the date of filing the shipping bill is CBSE notified 65, RBI rate 68, and receiving the money, the bank exchanged the foreign currency at 70 rupees. So what would be the turnover as per the financial statement? 68 lakh. What is the turnover as per the 1 lakh? No, 1 lakh dollar. So what is the turnover as per the audited financial statement? 68 lakh. What is the turnover as per the GST law? 65 lakh. So what you will have to do? Reduce 3 lakh. Right? The difference in revenue being 3 lakh would have to be reduced from the annual turnover as per the financials to arrive at the revenue as per the GSTR9. Right? Because we would understand, no, turnover as per audited financial statements plus minus, and then you come to the turnover as per the GST law. So as per audited financial statements, it is 68 lakh. So now minus 3 lakh, and then it will come to 65 lakh. And now, what was the rate at which it was booked in the book? 68. And what is the money received from the bank? 70. So the difference in the amount booked in the accounts and the actual amount received, 70 minus 68, 2 lakh, would be credited to the profit and loss account as forex gain. So again, this would be a part of your turnover. Again, that you need to reduce it from the turnover for GST, for the GST. Right? Even that would be your income. So that income you again need to reduce. So 3 lakh also reduced and 2 lakh also reduced. Next question, it says CBSE rate 65, RBI rate 68, but at the time of receiving the money 66. So first is same, 3 lakh to be reduced from the annual turnover. And now what is the rate at which it was booked? 68. And what is the revenue received from the bank? Rate 66. So 2 lakh is the forex loss. Right, would be debited to the profit and loss account as forex loss, which again needs to be added from the annual turnover as per the financial statements to arrive at the revenue as per the GST law. Right, it's GSTR9. So that you need to add back. Right, so forex gain you need to reduce and forex loss you need to add. Right, again R raised to 10, they can ask you a question from this one. Right, they can ask you a question from this one. Yes, are you all understanding? Right. So what is it? Total turnover as per the audited financial statements. 5 additions, 6 deletions and 3 plus minus. Right. So A is what? Turnover as per the audited financial statements. Then B, C, D, E, F. That is the addition. Then after that G, H, I, J, K, L. That is the deletion. And then M and O could be plus or minus. One, the valuation rule. Second one, the foreign exchange fluctuation. And third one, reasons not covered above. Right, then turnover as per after adjustment. Then the turnover as declared in the annual return. The difference and the reason. Right, that is the annual turnover. Now we will come to the taxable turnover. So now from this turnover under the GST law, we will reduce the nil rated supplies, exempt supplies, the no supplies and also the non-GST supplies. These 4 we will reduce and then we will come to the taxable turnover under the GST law. And then taxable turnover declared in GSTR9 and again the difference and the reason. Right, which are the 4 which you need to reduce? Right, no supplies, nil rated supplies, exempt supplies and the non-GST supplies. Right, so let us see the examples for those also. Right, let us see the examples for these 4 adjustments. Right, is supplies taxable at a nil rate of tax? Again, this is there in RTP May 19. Right, supplies taxable at a nil rate of tax. Currently, there are no goods and services under nil rate category. Right, then supplies that are wholly or partially exempted from tax, GST, by way of a notification, example, milk, water, education, healthcare, service. So, nil rated services, exempted services, supplies. Then non-taxable supplies, supplies that are not taxable under the GST law, but they are taxable under some other law. Example, alcoholic liquor for the human consumption. Right, so non-taxable supplies and no supplies. Right, whereas it is not considered to be a supply under the GST law. Right, neither a supply or of goods nor a supply of services. Sale of land or completed building. Right, actionable claims other than lottery betting and gambling. Right, what are the examples they have given? Consultation fees received by the hospital, exempted supply. Diagnostic services provided by the hospital, again exempted supply. So total turnover as per GST law minus this. and minus the consultation fee, diagnostic services, excess petrol available with the hospital sold to a related party, non-GST supply, and land sold by the hospital, again no supply, right? So that you will reduce it from the total turnover as per the GST law, and then you will come at the number of the total taxable turnover under the GST law. So that was total turnover as per GST law minus no supplies, exempt supplies, nil rated supplies, and the right nil rated and the no supply, right, non-GST supplies. That will give you the total taxable turnover. Right, then taxable turnover, on the basis of taxable turnover, now reconciliation of tax paid. So now already what number do we have? Taxable turnover. So depending upon the rate which is applicable, 5%, 12, 18, 28, 3%, and whether it is CGST, SGST, IGST, and the cess which is payable. Right, you will calculate what is the tax which is to be paid as per the taxable turnover which has been calculated above. Then tax paid as per GSTR9. Right, so total amount to be paid as per above, and then tax paid as per GSTR9. And again the difference and the reasons. Right, again the difference and the reasons, and the additional amount payable but not paid, now to be paid through cash. Right, so what was point 1? The basic details. Are you getting what is point 1? Basic details. Then point B, the reconciliation of point 2, the reconciliation of the turnover. 3, reconciliation of the tax paid. Now 4 is going to be the reconciliation of the ITC. Right, the reconciliation of the ITC. Right, so again the ITC as per the audited financial statements. Then that is which is to be claimed in the current year, add, which is to be claimed in the subsequent years, less. ITC as per the financial statements, then that which is to be claimed in the current year, add, that which is to be claimed in the subsequent financial years, less. That will give you the ITC, right? Then ITC claimed in the annual return. Then difference and the reason, same thing everywhere. You calculate a number, you compare it with the number under GSTR9, then the difference and the reasons, right? And then the reconciliation of the ITC declared in the annual return and the ITC availed on the expenses as per the audited financial statement. So now one item of expenditure has been picked up. And that purchases, what is the value amount of total ITC and which is eligible for ITC availed. Right, so rent, royalty, employee cost, conveyance, bank, entertainment, right, total amount of ITC availed and ITC claimed in the annual return, again the difference and the reasons, and tax payable on the unreconciled ITC. Right, this is all point number 4. And then you have the last one, auditors recommend, point 5, the auditor's recommendation on the additional liability due to non-reconciliation. Right, so part 1, basic details, right? Then part 2, turnover. Part 3, right, regarding the reconciliation of the tax paid. Part 4, the ITC claimed. And part 5, the auditor's recommendation on the additional liability due to non-reconciliation. So the description, value, this central charges, the CGST, SGST, UTGST, integrated tax, GST, and the cess if applicable. And it also talks about the input tax credit, the interest, late fee, penalty, any other amount for supplies not included in annual return, erroneous refund to be paid back, outstanding demands to be settled, and others. Please specify. Right? So though it looks very scary, it's not that scary. You understand? No, you can get an overview. Yes, you can get an overview of what they are talking. Mainly in the exam, I expect a question from the part 2, which is regarding the reconciliation. So what you do, you try to remember 5 additions, 6 deletions, and the 3 plus minus. Right? You try to remember those points. That all comes under serial number 5. Right? That all comes under the serial number 5. And right now, this paper, document which I've opened over here, this is the original form GSTR9C. And so what you can do, it's a good idea to study from this original GSTR9C, and then what you can do, read the content over here and see the explanation which is given in RTP May 19. And you read the content over here. Okay, B is what? Unbilled revenue at the beginning of financial year, and then they've given some explanation over there that you can go through. Right? But this should be your control sheet. right? It's easy to study from this one. And even at the end of this reconciliation, please don't talk, right? Even at the end of this reconciliation, they have given some very simple explanation. Okay, 5A may, what will come? And turnover as per audited financial statements. 5B may, unbilled revenue and the basis of the accrual system, right? At the end, beginning of the financial year. 5C, value of all advances. 5D, 5E, right? So here also they have given simple one, no? Right? A more easier explanation of what comes under each of these